Most people don't listen to me on this. My philosophy is that you should pay yourself a salary, even if it doesn't show up on the P&L. Decide first how much you're gonna pay yourself, and then reverse engineer the business around that. It sounds selfish, but it directly ties the benefit back to you. Dylan, what's up, man? We're back. What's cracking?
Not much. Just enjoying the fall weather here in Toronto. Beautiful time of year. Probably a little bit colder than where you are, John, but I'm not complaining. It's nice.
It just cooled down this week. It was like 90 Fahrenheit last week, and then we just finally had our first 50-degree morning yesterday, which is probably still much warmer than like daytime temperatures when you guys get in the deep fall out there. But yeah, I love fall.
Yeah, I can do Canadian weather 9 months of the year. So January to March, not my favorite. But it's also, as it gets cooler, it signifies BFCM around the corner, which is a lot of fun. So it's a good time of year.
Awesome, man. Well, everyone listening should be pumped about what we're talking about today, because we're talking about paying yourself more. That's right. Founders, owners want to pay yourself more. Here's how. That's what we're chatting about today on the Ecom Scaling Show. So I'm curious, Dylan, because obviously on the finance side of the world, we talk about this all the time. It's a pretty typical topic that we're chatting about with our clients. Where does this show up for you guys on the marketing agency side of the world?
Pretty often. There's a lot of instances where stores have healthy net profit, but due to poor cash flow planning, they basically have a hard time distributing capital to either the founder, shareholders, et cetera, et cetera. And I think it's most prevalent in stores with a lot of SKUs, because I'll give you an example. Let's say you buy $100 worth of items and you move through $70 of them super profitably, but now you have to go and order another $100 worth of items before you sold the entirety of the last PO. All of a sudden, you could have net profit on that, but you haven't recouped all your capital from the last PO run. So we see it a lot. Honestly, it's most common in like mid 7-figure to like low 8-figure businesses where a lot of cash is just constantly being reinvested into growth for more volume, where net profit looks good, contribution margin looks good, and cash flow is the primary concern. So definitely something that has to be thought of more so on the inventory planning side, the demand planning side, how you kind of prioritize moving through certain units. There's lots to consider there.
For sure. Yeah. As you were talking, another thing that is something that brands need to be more intentional thinking about related to paying themselves, or like the owners paying themselves, is be clear about where you're tracking that on your financials. Because depending on how you're set up, there's some brands where from an ownership or from an entity structuring standpoint and a tax structuring standpoint, you are on payroll. But there's a lot of brands we work with in the US where if it's closely held private company, they're usually what's called a pass-through entity, S Corp or LLC tax as an S Corp or LLC tax as a partnership. And your pay is going to show up on the balance sheet and the cash flow statement in the form of an equity item called distributions, right? And so being clear about whether your pay is baked into the P&L in the first place or it's on the balance sheet as distributions is super key to start, right?
Even I have a question, John, on that point. Like, even in those scenarios, do you still kind of like advise that brands kind of like factor in their like set pay in fixed costs, and then there's just like distributions with what's left over? So even on the balance sheet or the P&L, whatever you said, it shows up as a distribution, but you're kind of already factoring in that distribution into your cost planning.
Yeah, really, really good question. And what I want to say before I answer this is, most people don't listen to me on this, okay? But this is my philosophy. My philosophy is that you should pay yourself a salary, right? Even if it doesn't show up on the P&L, you should decide on a salary that is, the definition of it should be built around this definition: the market compensation for the role you play in the business, right? So if you are, I don't know, let's say you're primarily like the CMO and maybe the COO, right? Roughly paying yourself monthly or weekly or bi-weekly, whatever, what the rough market comp is for that role. And if you can put it on the P&L, you may not be able to because your tax accountant may not want it there for tax purposes, but at least in your financial modeling, you should account for it as a fixed overhead expense, because if at some point you hire someone, right, to fill that role, that is an expense that is going to show up on your P&L. So it's more about like not kidding yourself about where the true break-even point is of your business from a P&L standpoint. So I recommend paying yourself monthly what your market comp is for the role that you play in the business. And then distributions, think about it on, I typically say a quarterly basis. If you have enough cash flow, you can do it on a monthly basis, but at least quarterly. That is some share, some percentage of the profits that the business has made over the last quarter and exists in cash that you distribute to yourself. And that's for being an equity owner. That is the bonus, a profit bonus, because owners, definition of an owner for equity holders, you have a right to future profits. You have a right to profits. An employee, which if you work inside your business, you're both. You're an employee by serving a role which gets paid a market comp salary, and then as an owner, you get rights to some portion of the profits. And so even if you don't record it that way in the financials in like, say, your QuickBooks, I still like brands to think about it like that on a monthly basis. So let's just say that we decide we're going to pay you $10K a month as your salary. Even if they take it as a distribution on the balance sheet, 1st of every month or 15th of every month, pay yourself $10K. You do that every single month unless we decide it needs to be decreased or increased. Then quarterly, let's look at the balance sheet and the P&L to determine what you get to take every 3 months. And that is a reward for having profits and cash flow that the business has generated every single or over the last 3 months. That's the philosophy I like to follow. I do have some brands that follow that, a lot that don't listen to me, but that's the way I prefer to think about it.
Yeah, I think there's also like potentially an argument to be made that you time the distributions like after like key moments or like key risk events. Like if you are doing like a cash flow planning exercise and you're thinking about like a distribution going into like BFCM, well, it can dramatically, depending on how that goes, can have dramatic impacts on the health and health and status of your cash flow. So
Totally.
I'm sure like other instances like that too, where you kind of have to like play a game based off of the marketing calendar in a way.
Yeah, 100%. That's why generally for an ecom brand, I like quarterly, because if you think about it, if you look at like beginning of April, beginning of July, beginning of October, beginning of January, right? You've kind of had, you've rolled through your seasons, and every brand has different seasonality in those quarters, but it is roughly quarterly. Like a brand that's slow in Q1, pretty hot in Q2, hot but not as hot in Q3, and then crushes it in Q4. So what you can do is at the end of each of those quarterly seasons, you can size the distribution for what just happened, right? And maybe size it for what's about to happen. So for example, like maybe you can take a nice one at the end of Q2 if you're busy in Q2, and Q3 you're busy but not as busy, but you've already got the inventory that you're burning through, right? But then at the end of Q3, you've had just a decent quarter, but you are really inventory heavy. So your snapshot cash conversion cycle is a lot higher because you're stocked up on inventory. So you take a small one before Q4, but then when Q4 is over and you liquidate a bunch of that inventory and the snapshot of your cash conversion cycle is now much lower and you turn a bunch of profit, you can take a nice fat one, right? So quarterly generally tends to fit well for kind of the seasonality calendar of working capital expansion and contraction, if that makes sense.
The businesses I see most commonly face the issue of like having a hard time pulling out cash in the form of distributions or just like having the free cash flow, etc., is like high SKU count stores, just because the margin for error on inventory tends to just be way higher.
Yeah.
So like inventory planning for those stores becomes way more critical, in my opinion, if you want to also like think about how to maximize your distributions. Would you say that's a common thing you see as well, or is there any other like major callouts where inventory planning actually is like a pretty critical piece in this?
Well, I actually like to think of it as that plus looking at your cumulative equity balance on the balance sheet. And this is something that I didn't probably pay close enough attention to before I started Free to Grow. But then when I started seeing like a lot of balance sheets for dozens and dozens of brands, a light bulb went off and I started going like, wait a second, like I'll give you two contrasting, or like two examples on the opposite sides of the spectrum. I'll look at a brand that is turning a really good profit. Their cash conversion cycle is just decent, meaning that they probably don't have the greatest inventory days and payables days. But I look at their equity balance and it's like $5 million. So what is the deal there? Even though they have high inventory days relative to their current sell-through, they've just never pulled profit. They've not kept up with pulling previous profits out of the business. So you could have a crappy cash conversion cycle today and still have cash to take out of the business. In fact, I have a brand right now that has 600 days of inventory on hand, but he has taken a bunch of cash out of the business because we're liquidating this massive inventory position of a durable good. It's not going obsolete. And we're not going to draw that inventory back up to where it was before. And during the time that we had to finance that massive inventory position, he just stopped taking distributions. And so what he did is he financed it with the historical accumulated equity balance in the business, right? But now the inventory is coming down and he's profitable, but it's not crazy profitable, but he's taking more distributions out than their profit, and they're overstocked on inventory. But it's because our strategy is we're not going to draw inventory back up to 600 days. We're going to get it down to like 120 days. And then he'll have to start drawing out distributions that are more commensurate or more aligned with his actual profitability. But until we get there, he's drawing out this historical retained earnings that he used to finance an overstocked inventory position. So the point I'm making is you have to look at cumulative retained earnings balance, right? Alongside cash conversion cycle and net working capital. It's not one or the other.
That makes sense. That makes a ton of sense. So basically, in certain situations, if you just have a lot of buffer in the business for some reason, you've opted to keep a lot in over time, you then basically can afford more consistency in your distribution, so to speak.
I actually see that more frequently than you would think in brands that like have been around for several years and they've had modest profits, like maybe 7, 8, 9% bottom line, like decent, not the best, not the worst, but they've just underpaid themselves out of fear of taking money out of the business and thinking they need more cash for growth. You do that for 5 years, even if you get overstocked on, and again, days inventory on hand, what does that measure? That measures the value of inventory relative to how fast you're selling it through. So you could have a year of inventory, which I would generally say is an overstocked inventory position. But if you've been too scared to take profits out of the business for the last 5 years, you still may have excess retained earnings that you can get out of the business, right? And so when you think about now contrast that with, I've seen brands that like they've been losing money. They made money at some point, something happened, they're struggling with customer acquisition costs rising, and they haven't turned a profit in 6 or 7 months. And they still have cash, and you're like, how is this unprofitable brand still alive? Because they're just chipping away at that retained earnings balance, and it's not zero yet. But I'll see it go from $1 million to $500K to $300K, and now they're at maybe $65K. And they're like, I want to take more money out of the business. I'm like, don't, because if you take out $66K, your equity balance will be negative. And if your equity balance is negative, it means that we have more, our debt on the balance sheet exceeds the assets on the balance sheet, and that's risky business. But then brands ask me like, well, how do I increase my equity balance? You either put cash back into the business through, equity investment, or you increase profitability and don't take it out for a while and let that retained earnings buffer build back up, right? So anyways, those are kind of the key levers that I'm usually helping brands through.
When thinking about building up that equity balance, smart use of debt, so you can afford to pull more out, or how do you think through that?
It definitely depends. Well, let's talk about like what is smart use of debt, right? Smart use of debt, I think, depends on, last episode we talked about the different games, the high LTV, the LTV to CAC game, the high SKU count apparel game, and the new customer dominant, like durable goods game. The definition of responsible debt is different for all three of those because we have to think about the risk of the underlying asset that's being used to finance it, right? And so in this case, for an ecom brand, inventory. So what's the risk of the underlying inventory asset of a high LTV brand versus the risk of a high SKU count apparel brand that has high seasonality or high seasonal obsolescence risk, and then a durable good that's new customer dominant. And so we can actually go more aggressive with debt on a less risky, say, high LTV subscription product inventory asset, and maybe less aggressive and less risky on the use of debt on a new customer dominant brand, sells a durable good that has increasing competition and CAC is rising really, really fast. And so I guess the point I'm making is you're probably using debt to finance inventory to free up cash to take distributions. That's okay. But you have to be so honest with yourself about how risky the inventory asset base is that you are financing. And that's largely driven by which game you're playing.
Yeah, makes complete sense.
One thing that I'm curious about is that how often on the agency side are you guys battling against a brand not allocating enough capital towards inventory, or maybe misallocation of capital towards the wrong inventory, because capital is being deployed elsewhere, when it should actually be going towards buying SKUs that you guys should be selling?
Yeah, I'd say like it's pretty rare that we have instances where we see brands like pulling out so much cash to the personal that that causes the bottleneck. But super commonly we'll see like way large over purchases of inventory that just like kills cash flow. So I think that like one of the things that I'm earning an appreciation for is I think that we talk a lot about marketing and finance on the spot and how they kind of interact. I actually think inventory in a lot of ways is like the thing that sits in the middle, because how
Totally.
much you buy impacts what you should market, how you should set your targets for marketing. I really think that that is like the thing that sits in the middle. And I think that the best brands that have a lot of SKUs, they do a really good job of communicating priorities to the marketing team, other than just, hey, I want this contribution margin or net margin. I want this like sell through, even if I want it to be profitable, but if it's a couple percent less profitable than this thing, I'm okay because I have a ton of this. Or hey, it's seasonal, we're going to run out. And I think a lot of the things that I'm thinking about these days to like better serve our clients and just like improve the quality of our service is how do we help brands bridge the gap to optimizing for not only profit, but also the sell through of the right stuff. A lot of high LTV, like simple replenishable businesses. In general, like if you have a consumable product, we work with some brands that have consumable products that have dozens and dozens and dozens of SKUs. So maybe that's it does happen, but by and large, they're often lower SKU count stores, not as big of an issue. But for these like high SKU count, maybe you have colors, sizes, a bunch of categories. I think that cash flow as a target for the marketing team is really important. It can't only be net profit. And you have to kind of balance the two at any given time. And how do you balance the two? I think that's like the thing that we're working really hard at the moment. I think that's something that, is kind of the next frontier of improving marketing strategy as a whole.
For sure. So that makes me think about a couple things to kind of add on to that. Like, one, how you design the demand planning process, and I would even say the new product introduction process, right, is gonna be super, super key in that. And the reality is, I will say this. I don't know if you ever read the book Profit First. I recommend every person listening to this to just go
That's a great
read
book.
it. And I don't think you need to implement it in its entirety, but I think some version of it is key, right? And I believe actually Profit First is where I got the whole like pay yourself a salary and take distributions quarterly, right? But all that aside, one of the key things in that book is that decide the schedule. Decide first how much you're going to pay yourself and the schedule with which you're going to pay yourself, and then reverse engineer the business around that. Is there give and take? Of course, there's give and take. There's times when it's like, okay, I can't pay myself what I thought I was going to be able to pay myself. But the point is, take your money first, or at least plan to take your money first, because then here's the key. When someone on your team says, hey, I think we need to launch this new product, it's now threatening your pay. And when a decision about some investment, the trade-off is if this goes wrong, I can't pay myself as much. I'm telling you, you will really start thinking hard about whether or not that's a good investment of capital, right? And it's key. It sounds selfish, but it directly ties the benefit back to you, the financial benefit back to you as the owner. And so now it doesn't become about like, oh, would it be cool to launch this product? What our customers think it's cool. Like how much revenue can it do? It's now like, will this actually translate to more value to me financially as an owner at some point? And that's important because at the end of the day, we're in a money business, right? Businesses, it's a money game. It is like, and you need to do good things and you need to solve real problems for your business to be durable and withstand the test of time. But you're playing a money game. And ultimately, you're playing a money game to pay yourself money, either now or in the future. And so when you start by scheduling how much you're going to pay yourself and when you're going to pay yourself first, and then reverse engineer your P&L and your cash flow around that, now every decision, the trade-off is this going to impact me personally financially? And that's the whole point of that book. It changes your whole thinking about like, what's the minimum ROI I need to get off of this particular decision?
Yeah, I think constraints are just powerful. And if that then echoes through the org, where like if you factor in like if you think about a lot of businesses, if you like look at if you tell your marketing team this is the net margin I want or the contribution margin I want or whatever, if that's not factoring in what you want to distribute and taking into account, then technically it's potentially, misleading of what you actually wanted the business. I couldn't agree more. I think when you factor it in ahead of time, constraints are what will like spur the thinking to figure out how to get to that outcome where you can pull that much out or pay yourself this, that, or the other thing. And I also just think like most like a lot of business owners dream of like some great eventual exit outcome, but for many or most, it's just not going to happen. And having the discipline around how you think about distributions, I think, is the other way in which you continue to build that value personally over time. So I think it's definitely a balance. But I read that book and I love that book. It's great.
Yeah, for sure, man. One other thing that I was thinking about as you were talking is like, I think it also, in terms of like wanting to pay yourself more, going back to the fact that there's two components of pay. There's the market comp for the role that you play in the business, and then there's your share of profits periodically. You can, as the business grows, you can actually decide to pay yourself less by removing yourself from the business and paying someone else or someone else's like salaries, market salaries to run the business and work in the business. And you can just enjoy the rewards of being an equity holder and decide to take your time and go do something else. That's okay too. We have some brands we work with, that's the setup. The owners, they don't get a salary. They literally hired a CEO, hired an executive team, and they have some sort of a cadence where they're involved in strategic planning or like major decisions, but they just get quarterly distributions. That's okay too. That's not the case for most brands we work with, because most brands that we work with are founder, owner, operator led, right? But keep in mind that when your business gets to a certain size, if you start building a team around you, you can pay yourself less, but free up your time and pay the market comp to other people to run the business, and you just live off of the profit. So that is an alternative that's not right or wrong, and may be right for some people depending on what your goals are.
100%.
Any final thoughts, Dylan?
Yeah, I think like again, I see this most frequently on the marketing side when it's a high SKU count store. I get it a lot between like the smaller brands we tend to work with are usually on the low end, doing a couple $1 million a year to like low 8 figures. And I think that like the most common issue is just like way overstock on inventory, and inventory being the primary culprit of causing issues with being able to pull out cash. And I think that inventory planning is crucial when kind of optimizing this. And I couldn't agree more with a lot of what John said, specifically when it comes to like, the profit first mentality and just factoring things in advance. I think constraints are hugely important towards target setting. And I think that these things have to be factored in if you want to optimize this optimally.
100%. Yeah. And I would say my final thought is just like, be intentional about it. Say ahead of time how you're going to pay yourself, what the schedule is going to be. And if you want two key areas on your financials to focus on, it's your cash conversion cycle, mostly around inventory days and payables days. and your cumulative equity balance. Those are the things that are going to matter. So, yeah, man, this is a good one. That's a wrap.